Hi, this is Sajag Patel with the Bold Real Estate Consultants here. Welcome to our video blog. Today I'm here with Don Jarecki from First Federal of Lakewood, and we're going to be talking about the recent Fed interest rate increase. But before we begin, I would like to draw your attention to two links on our blog. First, if you're looking to sell your home, click on the free home value report link. Or if you're looking to buy, click the search all homes for sale, where you can access the most up-to-date information on the homes for sale in the area. Now, back to our blog.
So Don, back in December, the Feds announced that there was going to be a change in the interest rates this year. How's it going to affect our buyers that are looking to buy in today's market, or even at some point this year in 2016?
In the short term, essentially it really hasn't affected anything yet in the housing market, because what's happened is interest rates initially dropped after this recent raise in December. Reason being is the market had already priced itself into that raise that was going to take place in December. Now, the Fed was meeting today, which is today, January 27th. They're wrapping up their meetings this afternoon. I don't think they're going to do any raising today. You'll probably see anywhere from another quarter to a half raise by the end of the year here. Essentially what that'll do, it'll probably tick rates up maybe 0.25%, which is only about $30 on a $225,000 loan. So it's not as drastic as people may think, but going forward, if you're looking to do something, now's the time to buy, because over the next 12 to 18 months, you will see rates increasing a lot more than just 0.25% to 0.5%.
Okay. And with the raise in the rates and the small $25, $30 raise in the monthly payments, how's that affecting certain buyers that, let's say someone's qualified for $200,000 right now? What's that going to do to their pre-approval if they've already been running at a tight margin?
Well, if you get somebody that's in a 5 or 10% down position, something less than 20% down, and the debt-to-income ratios are real tight, that extra $25 could throw them out of qualifying. It doesn't mean they're going to drop them out of qualifying by $10,000 or $20,000, but if they're really on the border, it could kick them out of qualifying.
Okay, great.
So Don, what about the sellers who may be considering potentially refinancing this year? How's it going to impact them?
Well, if a seller's looking to refinance, now is the time to do it, because with the rate increase that took place in December, rates have dropped a little bit since then. So now is the time to refi. Going forward, let's say the second half of the year, rates are going to be up a good quarter, 3/8, maybe a half, depending on what happens in the economy. So if you're going to refi, now's the time to do it.
Okay. And the people that really benefit from the refi are the ones who are thinking about staying in their home long term, not someone who's going to potentially think about selling in the next 4 to 5 years, correct?
Yeah, the old rule of thumb was an interest rate should drop by at least 1% to make sense, but you have to look at the big picture as to why somebody's refinancing. If you're going to stay in the house for at least 3 to 5 years, regardless of whether it's a quarter or a half, you should refinance as long as your intended stay is going to be at least 3 to 5 years.
Okay, great. Well, thanks for joining us, Don, and thank you for watching our video blog today. If you know of anyone who's looking to buy, sell, or invest in real estate, please feel free to give the Bold Real Estate Consultants a call, and we'll be more than happy to give you a free consultation.